Okay, dear students, let's start our first Grand Live revision class, and today's class is going to be extremely important. What exactly we are going to cover in today's class? One, we'll be discussing all the rules of capital allowances for individuals. Along with that, we'll be discussing SBA, Business Structured Building Allowance. We will also be discussing capital allowances for corporation tax. And after that, we'll be discussing, I would say, a very comprehensive question on capital gain tax as well as IST. Through that question, we will be revising, I would say, a really major part of capital gain and IST, but don't worry at all. After that, in the next class, first we will be revising all the rules properly of capital gain as well as IST as well. But in today's class, I want to revise, let's have a revise major rules through a question. And at the end of today's class, I'll be discussing what exactly we are going to discuss in the second Grand Live revision class. Something new, and the coming, I would say, Grand Live revision classes, they will be very long. And I'll explain each and everything. But it's my request, do not miss any live revision class. Please do not miss. If you miss due to any reason, then must watch the recording. Like in today's class, we'll be discussing a question. That question we have not covered before. It's not already, it is not there in the pre-recorded lectures. So we'll be doing something new, okay? Let's start capital allowances quickly for individuals first. When we say capital allowances, so capital allowances, they are available according to your accounting period. Irrespective of the date of purchase, if accounting period is of 12 months, you will get capital allowances for the 12 months. Capital allowances are available on plant and machinery, and they are available according to the accounting period. If accounting period exceeds 18 months, then you have to split that into 12 months and excess months. Okay. Plant and machinery is something which a trade is carried on except doors, walls, windows, ceiling, floors, and water wiring, electrical wiring, gas wiring. Other than that, everything we take in plant and machinery. If a business is VAT registered, so we know that a VAT registered business obviously will get input VAT from HMRC. You will simply your input VAT will be refunded to you by HMRC. In that case, if your business is VAT registered, you will get capital allowances on VAT exclusive values. VAT exclusive means without the impact of VAT. But if your business is unregistered with the VAT authorities, then obviously you cannot claim your input VAT. In that case, you will be getting capital allowances on VAT inclusive values. If a business is VAT registered, all additions of plant and machinery are recorded at VAT exclusive prices, but there is an exception. Except car which are included at VAT inclusive price. If a business is not VAT registered, all additions are included at VAT inclusive price amount. Inclusive means including VAT. Pre-trading purchases, the 7-year rule applies. If incurred in the 7 years before trade commence, are treated as acquired on the first day of the trade at its market value on that day. Now, there is a possibility before commencing the business, owner has bought up land and machinery, let's say 3 years before starting the business, 4 years before starting the business. So that will be treated in a pre trading capital purchases, and you will get capital allowance on that purchases as well if it falls within 7 years before starting the business. Capital allowances are given on an original cost and any subsequent capital expenditure. Cost of alteration to the building needed for installation of plant and computer software costs will also become part of a plant and machinery. So, for the sake of installing plant and machinery, if owner has done some alteration in the building, so that cost of alteration will be a part of plant and machinery. Replacement expenditure also qualifies for capital allowances where more than 50% of asset is replaced in a 12 months period. This prevents substantial repairs being treated as revenue expenditure for tax purposes. So very important, replacement expenditure also qualifies for capital allowance, where more than 50% of asset is replaced within 12 months period. The whole objective is you should not treat such a significant expenditure as a revenue expenditure. That is your capital expenditure and you will be getting capital allowance. Hire purchase, finance costs, assets are recorded as plant and machinery at the date of contract at market value. Exclusive interest paid is allowed for trading expense. But normally we don't see this hire purchase, finance lease in our past papers. Partial claim for capital allowances are allowed. So an individual claim full, partial or not capital allowances if considered it advantageous. Normally every individual goes for the full capital allowances, but if it is advantageous not to claim all the capital allowance, then individual can claim partial. Example of plant and machinery, computers and software, machinery, cars, lorries. Office furniture, movable partitions, air conditioning, alterations of the building needed to install are part of plant and machinery. Spatial rate pool. Now, very important point is, if an asset belongs to a spatial rate pool, then WDA percentage is 6%. Following plant and machinery will become part of a spatial rate pool. One is long life asset. It includes plant and machinery with a working life 25 years or more. So in case of a long life asset which is having a useful life 25 years or more, it will be mentioned in the question. So you just need to know one thing, long life assets, they fall in a spatial rate pool. And that another thing is the life is 25 years or more and annual running cost is 1 lakh pound or more. Integral features of a building, they also fall in a spatial rate pool. It includes electrical and general lighting system. That's number 1. Cold water system 2. Space or water heating system 3. Power system for ventilation 4. Cooling or air purification and lifts and escalators. They all are integral features of a building, of course, and they fall in a spatial rate pool. You need to know this. You need to know the names of integral features of a building. Motor car, both new and second-hand with CO2 emission more than 50 grams. Actually, when car is having a CO2 emission more than 50 grams per kilometer, that is a high emission car. High emission car falls in a spatial rate pool again where WDA is 6%. Thermal insulation of building falls in a spatial rate pool. Now, general pool or main pool. The cost of most of the plant and machinery purchased by a business becomes part of a pool called main pool on which capital allowances may be claimed. New or second-hand car having CO2 emission between 1 gram to 50, they are treated as a standard emission car. They fall in a main pool, general pool, where applicable written down allowance is 18%. So new or second-hand cars having CO2 emission between 1 gram till 50 are included in the main pool. Second-hand cars with CO2 emission 50 or more, 50 or below, they fall in 50 and below, they fall in general pool. Addition increases the amount of pool and disposal reduces the amount of pool. Sale of plant and machinery. On disposal of plant and machinery, deduct the lower of sale proceed and original cost, whichever is lower, from the total of written down value brought forward on the pool plus addition to the pool. So basically, if during their owner has sold any plant and machinery, you will be deducting from the relevant pool either sale proceed or original cost of the plant and machinery, whichever is lower. After that, if there is any addition in that pool, take that addition. And after taking the impact of disposal and addition, then whatever amount comes, on that amount, you will be calculating written down allowance. Now, short life asset. A very important point is, let's say, owner has bought a plant and machinery, and owner is having the intention to sell that plant and machinery within next 8 years after the year of purchase. If you include the year of purchase as well, then it becomes 9 years. If I say owner is having the intention to sell the asset within 8 years after the year of purchase, so I'm saying the same thing. Because if I include the year of purchase, then 9 years. If I'm saying owner is having the intention to sell the asset within 8 years after the year of purchase, that sort of asset is treated as a treated as a short life asset, number one. Number two, each short life asset will have a separate pool. Another point is logically, technically, only those assets should be depooled by the owner. Number one, owner is having the intention to sell it within 8 years after the after the year of purchase. But in addition to that, owner is having the estimations that on the disposal of that plant and machinery, there will be balancing allowance. So on the disposal of that asset, if there will be a balancing allowance, only then it should be depooled. Because if owner knows that I am going to sell the asset, let's say within 8 years after the year of purchase, and on the disposal, that asset will result in, let's say, gain, will result in balancing charge, then according to the tax planning, it is highly advisable do not depool that asset. Let it remain in the main pool. Because in the main pool, when you are selling the asset, you will not be having these issues. Because when you are selling a single asset in the main pool, single asset in the main pool cannot result in a balancing charge or a balancing allowance. In fact, in the main pool, if owner sells all the assets, even though the business is not ceased, business is not closed, but owner is selling all the asset, balancing charge can arise. But in the main pool and special rate pool, balancing allowance can only arise when the entire business is ceased. Otherwise, balancing allowance will not arise. Plant and machinery which individual wishes to sell or scrap within 8 years of the end of the period of account in which asset is purchased are called short life asset. Every short life asset is kept in separate pool. Cars can never be classified as a short life asset. Annual investment allowance, written down allowance are available on net value as normal. Balancing allowance or charge on disposal within 8 years after the accounting period of purchase. Obviously, when you are selling the short life asset, either there will be balancing allowance or balancing charge, but a tax planning says make sure on disposal there should be a balancing allowance. Let's say if 8 years have been passed, but still asset is not sold, then if no disposal take place within 8 years after the accounting period of purchase, the remaining balance is transferred to the general pool immediately. Privately used asset. Each privately used asset will have a separate pool. And this privately used asset concept rule is only applicable when we are dealing a question of individuals. If I'm solving the capital allowances topic, I'm dealing with the capital allowances in case of corporation tax. You will not have any privately used asset column in case of corporation tax. So privately used asset column is only possible. This concept is only possible when we are dealing with the business of individual. And owner is, let's say, using a car 30% for private use, 70% in the business. So each privately used asset will have a separate pool. If owner uses an asset for private purposes, capital allowances are given only on business proportion. Every private use asset is kept in separate pool. On disposal of the asset, balancing charge if profit or allowance if loss will arise, which is then reduced to the business proportion. On the disposal, if there is any balancing allowance or charge, you owner will get, but according to the proportion of the business. Private use of an asset by an employee has no effect on capital allowances. Because when your employee is using the asset, so then it is treated as a business use. Very important rule, I would say, annual investment allowance. It is allowance of 1 million per annum on a new purchase of plant and machinery other than cars. Cars do not get annual investment allowance, but lorries do get annual investment allowance. It is only the cars. They're not getting any annual investment allowance. And this 1 million is for a 12 months accounting period. If your accounting period is other than 12 months, then this 1 million will be time apportioned. Value of a new purchase of plant and machinery which exceeds 1 million per annum will be transferred to the relevant pool. For example, owner has bought a plant and machinery having the value 1.5 million. And let's assume that plant and machinery belongs to the main pool. Let's say you have taken AIA, annual investment allowance 1 million. Remaining 5 lakh will be transferred to the relevant pool. If that plant and machinery belongs to special rate pool, then remaining 5 lakh will be transferred to the special rate pool. If that belongs to the main pool, then remaining 5 lakh will be transferred to the main pool. 1 million limit is prorated for short and long period of account because 1 million is for a 12 months accounting period. No annual investment allowance is available in the year of cessation of trade. In fact, in the year of cessation, even you are buying plant and machinery, you will not getting any annual investment allowance. In fact, in the year of purchase of, in the year of sale, in the year of cessation of the business, even you bought plant and machinery, you are not getting any annual investment allowance. In fact, in the year of cessation, you will not even get capital allowance. In the year of cessation of trade, either there will be balancing allowance or balancing charge. How to utilize annual investment allowance according to the tax planning? It is most beneficial to claim annual investment allowance in the following order. Number one is a special rate pool. Students, can anyone answer why we are saying use AIA first against the special rate pool? Why we are saying to use annual investment allowance against the special rate pool first? Any specific reason of utilizing annual investment allowance first against the special rate pool? Students, please reply. What do you think? What is the reason? Okay, let's see. One student says because they are long life assets. Then so what? They're long life. What is the main reason? Why we are saying annual investment allowance should be utilized first against the special rate pool? Student, please. Any logical answer? What is the WDA percentage in a special rate pool? What is the WDA? I'm asking student. 6%. And in other pool it is 18. So can I say, since in a special rate pool, WDA is lower than other pools. So it is highly advisable utilize annual investment allowance against the special rate pool. So if someone asks you what is the reason is because special rate pool is having WDA lower, it is having 6%. So that is why we are saying first utilize AIA against the special rate pool. Then go for journal pool. Then go for short life asset and finally go for private use asset. But make sure if your privately used asset is a car, cars do not get annual investment allowance. Okay, now related businesses, only one annual investment allowance is available to related businesses. Businesses owned by the same individual are regarded as related where they engage in the same activities or they share the same premises. For example, we have a same business premises and assuming early in the morning since afternoon in the same premises, owner is running company one, and then from late evening till late night, business is running another company. So you are sharing the same business premises. You will not be getting, even though you have registered two different companies, two different businesses, but you will not be getting more than one AIA. You will be getting only one AIA because of the related businesses. For example, let's say owner is using the same premises to provide physical classes, let's say, and as well as online classes. Again, related business. You will get only one annual investment allowance. In such circumstances, owner of the business can choose how to allocate single AIA between them. It is up to the owner. Now, written down allowance is available on net value, WDA plus addition less disposal. So you will take opening written down allowance. We will add the additions during there. We less the disposal. Written down allowance is 18% on reducing balance method is given each year on main pool. 6% on a special rate pool. If the net value in the net value means opening value of written down allowance plus addition minus disposal. If net value in the special rate pool or main pool is negative, then balancing charge will arise and deducted from the capital allowances column. Balancing charge means simply gain, and that gain actually reduces your capital allowances. Full WDA is given in the year of purchase, no WDA is given in the year of disposal. 6% 18, they will be prorated if accounting period is, let's say, less than 12 months. If net value in the amount of main pool or special rate pool is less than 1000, then 100% WDA is available and that is called as small pool. 1000 limit is for a 12 months accounting period. If accounting period is different than 12 months, then this small pool limit of 1000 will be time apportion. Another important rules I would say, first year allowance. First year allowance 100% is available in the year of purchase on purchase of a new electric powered car with zero CO2 emission. First year allowance is not time apportion no matter your accounting period is less than or more than 12 months. No first year allowance is available in the year of cessation. Cars, new electric powered motor cars with zero CO2 emission are eligible for first year allowance 100%. Second hand electric powered cars with zero CO2 emission are eligible for 18% written down allowance. Both new and second hand cars emitting CO2 emission 1 till 50 include in the main pool. Both new and second hand cars emitting CO2 more than 50, they will go to special rate pool. If there is a private usage by car proprietor, not employee, then only business proportion of capital allowance will be claimed. Cessation of the trade. You will not get any first year allowance, you will not get any annual investment allowance, WDA is available in the last year of trade. No. In the last year of trade, simply in the year of cessation of the trade, either there will be balancing allowance or balancing charge. Add additions and deduct disposal made in the last period of account from the relevant pool. Calculate balancing allowance if loss or balancing charge if profit as appropriate. If business is sold to a connected person, student, it says if this is very important point and this point has examined, it has appeared in exam, I would say 3 to 4 times. If business is sold to a connected person or to his own controlling company as a going concern, an election to be made to HMRC to transfer WDA instead of market value and avoid balancing charge or balancing allowance. My question is, give me at least 1 or 2 examples what comes in connected person. Student, please. If business is sold to a connected person, so simply you can transfer your plant and machinery at their written down values. So simply there will be no balancing allowance, no balancing charge. But the rule says you are selling the asset to the connected person. My question is, give me the examples of connected persons, please. Students, okay, let's see. Someone has written, okay, spouse or civil partner. Spouse or civil partner, business partners, okay. You can say your direct relatives of your spouse. Okay, they come in, actually they fall in connected person. Great. Now come here. Balancing allowance, balancing charge. We know that net value means what? Opening written down allowance plus addition less disposal. Main pool and a special rate pool. Net value is positive in the regular year. I'll be using either 6 or 18%. Balancing allowance in the main pool and a special rate pool can only arise in the year of cessation. Let me repeat, balancing allowance means loss on disposal. Balancing allowance can only arise in main pool and a special rate pool in the year of cessation of the business. Net value is negative, that is balancing charge. Balancing charge can arise in the regular year. Balancing charge can arise in the year of cessation. The rule is, in regular years, in the main pool and special rate pool, balancing allowance cannot arise. But balancing charge can arise in main pool and special rate pool during the regular years as well as in the cessation year. Private use asset and short life asset. Net value is positive if it is either 6% or 18. Disposal year, balancing allowance, cessation year, balancing allowance. Why we are saying this? Again, when we say privately used asset and a short life asset, I think I did mention just right now. Logically, technically, I would say depooling of short life assets should only be done when we know that when our estimations, they say that on the disposal of that asset, we'll be having a balancing allowance. Then you should depool that. Negative value balancing charge can arise in regular years, disposal years, cessation year. This is the format. Okay. Just you need to go through this format only once, I would say. SBA, structured and building allowance. SBA, can I say SBA is only 3%? This relief is given as an annual straight line allowance 3% over 33.33 years. 33 years and 4 months. SBA is only available where building or structure has been constructed. After 29 October 2018, however, a question will only be set where construction is on after this date. Offices, retail, wholesale premises, factories, warehouses can also qualify for SBA, as can walls, bridges, and tunnels. The value of the land is excluded and is as in any part of the building used as a dwelling house. Expenditure which qualifies as a plant and machinery cannot qualify for SBA. Similarly, expenditure which qualify for SBA, they cannot be a part of plant and machinery. Where an unused building is purchased from a builder or developer, then the qualifying expenditure will be the price paid less the value of the land. Where an unused building is purchased from a builder or developer, then qualifying expenditure will be price paid less value of the land. The building structure must be used for qualifying activities such as trade or property letting. SBA can only be claimed from when the building is brought into qualifying use. It means in the year of purchase, most of the time we'll be time apportioning the SBA. This means that SBA will be time apportioned for the period when the first bought into use. Unlike plant and machinery, allowance which always given in full in the period of purchase. A separate SBA is given for each building, qualifying for relief. Relief is only given for the cost of subsequent improvement or where building is renovated or converted. Disposal is important, okay? Unlike plant and machinery, there is no balancing charge or balancing allowance when the building or structure is sold. That is qualified for SBA is sold. Instead, the purchasers simply continue to claim 3% allowance for the remainder of 33.33-year period. Based on original cost means if, for example, the first owner was getting SBA at 4 lakh, assuming. So the second owner will also be getting SBA at 4 lakh. However, on the disposal of the allowance that have been claimed are effectively clawed back by adding them to the sale proceed in order to determine the chargeable gain. Basically, if we have sold the building, assuming for 2 lakh, and previously we have claimed SBA assuming 20,000. So logically, your sale proceed will be 2 lakh 20. Then I'll be deducting the cost to calculate gain or loss. You should assume that for any question involving the purchase as opposed to a new construction of a building, SB is not available unless stated otherwise. Very important point. If SB is available, it will be mentioned in the question. You are not going to suppose by yourself. There's no need to assume and calculate SBA. Now, students, capital allowances rules, they are exactly same in individual and corporation tax, except there are one or two rules which are different in case of corporation tax, which are not available to the individuals. Let us quickly discuss what are the different rules, differences in capital allowances when we are dealing with the capital allowances for corporation tax. Let's see. Okay, so here. Okay. Annual investment allowance is same. The maximum AIA for a 12 months accounting period is 1 million. And we know that this 1 million is for a 12 months accounting period. Same as for an unincorporated business. AIA amount 1 million is included in the tax rate. This will be given to you. AIA must be split between related companies. A group of companies, that is parent company and subsidiaries, are related. For the purpose of group, it is only entitled to one AIA. There's parent and 2 or 3 subsidiaries, then only one AIA is available. The group can choose how to allocate single AIA between the group companies. Okay. A group for this purpose is defined by the Companies Act essentially applies where a parent company holds more than 50% holding. Therefore, in an examination question related to capital allowances, for a company within a group, the allocation of AIA between the group members will need to be considered. When allocating AIA, the group members can allocate 1 million AIA in any ways. It is up to the group. I will share this page. This page will be uploaded with this video. Okay. AIA does not have to be divided equally between the group members. All of the allowance can be made given to one company, or any amount can be given to any member of the company. Companies owned by the same individual will also be regarded as related for the purpose where they are engaged in the same activities or same premises. For example, this could be the case if an individual runs two companies from home. In such circumstances, AIA will be split between two companies, and owner of the companies can choose how to allocate single AIA. Unrelated companies owned by the same individual will each be entitled to the full AIA. Student, this is now very important. Enhanced capital allowances. Now listen carefully. The concept, the rule of enhanced capital allowances is only applicable when we are calculating corporation capital allowances for the corporations. Enhanced capital allowances concept is not applicable, is not available when you are dealing a capital allowance question for individuals. Okay. It is only for the companies. It is only for the corporations. Companies purchasing a new qualifying plant and machinery between 1st April 2021 and March 2023 were eligible to claim 130% super deduction for asset which would ordinarily go into the main pool. What is the super deduction? 130%. 50% first year allowance for a special red pool. Repeat. For Corporation Acts, normally those purchases, they go to the main pool, they qualify for super deduction, which is 130%. Those assets, they go to the main pool, they qualify for the 50% first allowance for special red pool. For a special red pool assets, this is now very important, okay, this point. For a special rate pool asset, AIA would have been claimed in preference to 50% first allowance. You are not supposed to go for 50% first allowance first. In case of a special rate pool, students, first, companies, they will claim AIA. First, companies, they will claim AIA. After that, if there's a remaining balance, on that we'll get 50% first year allowance. With the 50% first year allowance applied on the balance. Again, a very important point. A question will not be set in the exam involving an initial claim for enhanced capital allowances, but you may be required to deal with the disposal of plant and machinery on which enhanced capital allowances were claimed. So logically, those plant and machinery against which we have already taken the enhanced capital allowances on the disposal, they will result actually in balancing charge. Why? Because the carrying amount will be 0. A question will not be set in exam involving an initial claim for enhanced capital allowances, but you will be required to deal with the disposal of the plant and machinery on which enhanced capital allowances were claimed. And these rules of capital allowances, which we have just discussed for individual and now we are discussing for corporation, they are 100% same for taxation students and for ATX. They are 100% same. Now, this is very important. Disposal of assets on which enhanced capital allowances were claimed. Disposal of assets that qualified for 130% super deduction will trigger an immediate balancing charge equal to the disposal proceed. Disposal proceed will be equal to balancing charge. So the asset against already your company has taken the 130% super deduction. Immediately, the disposal proceed will be treated as balancing charge. Disposal of assets that qualified for the 130% super deduction will trigger an immediate balancing charge equal to the disposal proceed. Second, disposal of assets that qualified for the first year allowance will trigger an immediate balancing charge, but how will you calculate? This is very important. Disposal proceed multiplied by proportion of expenditure on which first year allowance was claimed into 50%. Disposal proceed proportion of expenditure on which 50% first year allowance was claimed, then into 50%. Let me explain this part. Assuming spatial rate pool, organization bought an asset assuming the value of that asset was 1.3 million. Against that 1.3 million, organization has first taken 1 million AIA. Then remaining amount is obviously 3 lakh. Against that 3 lakh, company has taken, of course, 50% first year allowance in the year of purchase. Okay. Now, after that, the value is 150. Assuming in a very next year, I'm just assuming, okay, that asset is sold. And assuming that asset is sold for in a very next year, okay, after the year of purchase or maybe after just 2 years of purchase, that spatial rate pool asset examiner says we have sold it for 8 lakh. Disposal proceed is 8 lakh. Okay. Now, how will you calculate number one? Balancing charge on the asset against which you have already claimed the 50% first year allowance. And second, after claiming the balancing charge, what are you going to do with the remaining amount of the disposal proceed? Okay, let's see. Number one, how will I calculate the balancing charge? Balancing charge is equal to the sale proceed, which is 8 lakh. Multiply by the expenditure which qualified for first year allowance. In my example, that is 3 lakh, which qualified for 50% first year allowance. So I'll take 300,000. 300,000 qualified for first year allowance. Can I say out of 1.3 million? Come here. Proportion of the expenditure on which 50% first year allowance was claimed. Proportion. Company bought the spatial rate pool asset for 1.3 million. Can I say the entire 1.3 million did not qualify for 50% first year allowance? Out of that 1.3 million, only 3 lakh qualified for 50% first year allowance. So 3 lakh out of 1.3 million into 50%. Let's use the calculator, and I want you guys use the calculator also. Let's see what we are getting. 3 lakh divided by 1.3 million multiplied by 800,000 into 50%. 800,000 multiplied by 3 lakh divided by 1.3 million. Multiplied by 0.5. Students, I'm getting 92,308, you can say, with a little bit rounding off. Let's see what answer you are having. Okay, we're getting the same result. Logically, this 92,308, this will be the balancing charge. Okay. Now the disposal proceed is 8 lakh. From this 8 lakh, you will deduct the balancing charge. Let's see what is the remaining amount. 800,000 minus 92,308. The remaining is 7 lakh. 7,692. Now listen. The remaining disposal proceed will be deducted from the special rate pool balance. Repeat, remaining disposal proceed will be deducted from special rate pool. Let's see. The remaining proceeds are deducted from the remaining proceeds are deducted from the balance on the special rate pool before getting 6% WDA. Let's see this quickly. Calculate the maximum capital allowances Spirits Limited can claim for the year ended March 2024. Spirit Limited has an accounting reference date 31st March. During their ended 31st March 2024, Spirit Limited sold the following assets. Machinery for the proceed 70,000. This cost 90, on which 130% super deduction was claimed. Can I say entire 70,000 will be the balancing charge? Yes or no? Please reply. Entire 70,000 will be the balancing charge. Okay, now. Integral features, of course, they fall in the special rate pool. For proceeds 750. Okay. The original cost of these was 1.2 million, on which AIA 1 million was claimed and 50% first year allowance on the balance. Now come here. We are selling the integral feature for 7,50,000. Now try to understand. Original cost was 1.2 million, but they took first they claim 1 million at AIA. From 1.2 million, when I'll deduct 1 million, I will left with 2 lakh. So obviously the remaining 200,000 qualified for 50% first year allowance. So the expenditure is 2 lakh, which qualified for 50% first year allowance out of 1.2 million into 50%. I'm getting 62,500. This is the balancing charge. So disposal proceed is 750. From this 750, we'll deduct 62,500. Whatever comes, that will be deducted from the special rate pool before calculating 6% WDA. As it first applied 2023, the tax return on value in the main pool was 4,50,000 and a special rate pool was 1.7 million. Now coming. Opening balances, I don't think so any problem. Look at this. Entire 70,000, that is your balancing charge. This is balancing charge on selling the asset of a special rate pool. And look at this, balance of the proceeds, 7,50,000 minus 62,500. We are deducting 6,87,500 from special rate pool balance. On the remaining amount, we are getting on WDA 18% is applicable on the main pool, and on special rate pool it is 6%. This is the capital allowance. Of course, due to balancing charge, your capital allowance will reduce. So the final capital allowance is just 9,250. I strongly believe this calculation is clear per 100%. I hope, okay, we have the calculation here as well. You can see that. I hope this calculation is not disturbing at all. The format is also there. And let me repeat, the enhanced capital allowance and 50% first allowance, these rules are only applicable when we are calculating capital allowances for the company, and it is written in your syllabus that you will be examined only on the disposal of those assets on which super deduction first year 50% allowance, it has already been claimed. You will not be getting any question on where you have to initially claim these things. It's here. A question will not be set in the exam involving an initial claim for enhanced capital allowances, but you may be required to deal with the disposal of plant and machinery on which enhanced capital allowances were claimed. So as I mentioned earlier, these rules of capital allowances, they are 100% same for taxation students as well as ATX students. Now, students, let me share a question, as I mentioned earlier at the start of the class, that through a question, we will be discussing all the major, I would say, rules of capital allowances as well as IST. And I also mentioned that we'll be discussing a question which is already not available on our portal. Otherwise, we know that on our portal, there are lots of practice questions. From video number 84, they go till 125. All are the practice videos. But let's discuss a new question today. Let me bring that question. Students, a 30 marks question, extremely important question, I would say. This question is predominantly, I would say, on two topics. One is IST, another is CGT. John Arc. Okay. So we will be starting, I'm giving you just, and this is from your kit, Kaplan kit, question number 37. We will start this question within just, I would say, 5 minutes. And within 5 minutes, let me just prepare a black coffee for me. Because black coffee. But if you want to have black coffee, have in moderation. Too much black coffee is not good for the health. So within just 5 minutes, we will resume the class. I think you should stay online. There's no need to go anywhere. Okay, so let's attempt this question. But while attempting this question, I do need your full participation, okay? So be prepared. I'll be giving you a little bit scenario where I want you to do the calculation as well. You should assume that today's date is 1st April 2024. Advise John of the IST and CGT implications arising from the gifts made during the tax year 23-24. Everything revolves around the gifts. Your answers should be supported by appropriate calculations, should include an explanation of any reliefs that are available. For the explanation, student, you have to listen to me carefully and then you can write in your own wordings. In that way, we will be saving the time. You should ignore, this is also important. You should ignore installation option, an effect of annual exemption for IST purposes and annual exempt amount for CGT purposes. Wow. Normally, we know that in IST, you get annual exemption for the current year 3,000. If it is not used in the previous year, you will get 3 for the previous year unused annual exempt amount also. That is carried forward for 1 year. In case of CGT, you get annual exemption amount 6,000, but what examiner has mentioned here, you need to ignore. So now let me tell you one thing. If annual exemption is available, in your explanation, you do write that it is available, but it's mentioned in the question. That is why we are ignoring the impact. Marks for this part of the question will be allocated. 5 marks for part A, 5 for B, 3 marks for C, 5 marks for C or D, 6 marks for E, 24. Then we have a 6 marks question. Explain the main advantages of an individual making lifetime gifts for IST purposes. I think this question has been examined many times. Advantages of an individual making lifetime gifts for IST purposes and the main factors to be considered choosing which asset to gift. Okay. Another thing is they're saying John is a higher taxpayer for the income tax purposes. It means that if, for example, on any capital gain, we need to apply tax, I'll be using 20%. If John is selling the residential property in UK, I'll be applying the 28%. Why? Because John is a higher rate taxpayer. Okay, explain the main advantages. If I just give you a little bit idea for the lifetime gifts, can I say number one, annual exempt amount is available in IHT? Yes or no, students, please reply. One is annual exempt amount. Second, there's one more. Can I say if owner dies at least after 3 years of making the gift, can I say taper relief is also available? Yes or no? That logically taper relief also
Hmm?
reduces IHT.
Hmm?
Another, can I say during the
Yeah, what?
lifetime when the owner, when gift is made, if the value of that asset appreciates and donor dies within 7 years of making the gift, students, at the time of death tax, do we consider increase in value? Yes or no? Please reply.
I'm still in the lecture.
Do we consider?
Come and listen if you want. I'm
No,
still in
we
the
do
lecture.
not. We do not. In fact, if the value reduces, can I say then fall in value relief is available? If the value reduces, then fall in value relief will be available. Then fall in value relief will be obviously available. So I hope it is clear. Another thing is, can I say in case of PAT, if owner does not dies after the 7 years, then it becomes obviously exempt. Yes or no? So these are the, of course, advantages of lifetime giving for I lifetime gift giving during the lifetime, obviously. Okay, another thing is, can I say if
Okay.
if you look at the capital gain, if asset is given, for example, if asset is given as gift on death, can I say then there is no CGT? Because there is a possibility when you are giving gift during the lifetime, IHT is not coming, let's say it is PAT, but there's a possibility CGT might arise. Are you getting this point? CGT might arise. Until unless you are giving a gift of an asset which is exempt under CGT. For example, if you're giving gift of cash under CGT, there's no tax, it is exempt. Is this clear? Okay, now let's go for a question. And I really need your participation as well, students, on each and every part. Let's deal. John Ark, you should assume that today's date is 1st April 2024. John Ark, age 76. Wow, wow, wow. Has asked for your advice regarding the following gifts that she has made during the tax year 23-24. Okay. On 13 July 2023, John made a gift of 2,50,000 ordinary shares in Orleans PLC, a quoted company, into a discretionary trust for the benefit of her granddaughters. Okay. Discretionary trust is a relevant property trust. And simply when you are giving a gift to a discretionary trust, can I say that is CLT? It is a chargeable lifetime transfer. CLT. Is this clear? Giving a gift in a discretionary trust, a relevant property trust, that is CLT. Because individual is giving a gift to the trust. Gift from individual to the trust, that is CLT. Can I say when one individual gives gift to another individual, that is PAT. But when one individual gives gift to the trust, that is CLT. I hope it is clear to everyone. Are you getting this point, students? Please repeat. Answer. One individual gives gift to another individual, that is pat. But when one individual gives gift to the trust, that is CLT. Okay. On that day, the shares were quoted 146 pence and 150 pence. These are the quoted prices with recorded bargain purchase prices as well. Can I say under IHT, shares will be valued at lower of quarter up price and average bargain price. Repeat. Shares will be valued under IHT lower of quarter up method and average bargain price. Okay. John originally purchased 200,000 shares in Orlean PLC during 2008 at a cost of 1,49,000. Okay. John has also bought 75,000 shares on 15 August 2021 for 69,375 and subsequently bought 10,000 shares on July 2022, 14,800. Okay. Orlean PLC has an issued share capital 10 million and John has never been a director or employee of the company. Now, student, listen and listen carefully. Part A. I'll be needing this data again and again, so let me use part A. We'll be solving, of course, for all the gifts, and we want to see IHT and CGT implications. IHT and CGT implications. Number one, let's start with the IHT. In part A, there's a gift of John made a 250,000 ordinary shares in Orlean PLC. Orlean. Gift of ordinary shares in, what is the name? Orleans PLC. Can I say number one is IHT implications? Gift to the trust is treated as chargeable lifetime transfer. Chargeable lifetime transfer. Okay. The ordinary shares of Orlean, they were 10 million. And John is having just some of them. John does not have more than 50% holding. So can I say John does not control this organization? Am I right? Orlean PLC issued 10 million ordinary share and John has never been a director or employee of that company. So simply, can I say BPR, business property relief, is not available, as we know that the shares are in a quoted company and John does not have the control. Is this clear to everyone? BPR is not available. Why it's not available? Because shares are of quoted company. As the shares are quoted and John does not have a control. Does not have a controlling interest. Does not have the holding more than 50%. Can I say under IST, shares will be valued at lower of quarter up method? Students, under quarter up method, what are we going to do? We will take
A penny.
number one, the difference of highest and the lowest quoted price, number one. Look at this. Highest quoted price, lowest quoted price. Can I say highest quoted price? It is in pence. Minus the lowest quoted price divided by 4 plus the lowest quoted price. So lowest quoted price plus then highest minus lowest divided by 4. So quickly, can please anyone use a calculator for me? Quarter method.
Give him in a plate.
The lowest is 146. It is pence, okay? Plus 150 pence minus 146 pence divided by 4. Can I say 150 minus 146 becomes 4? 4 divided by 4 is 1. Can I say 147 pence? This lower of 1 and 2. One is quarter up and the second is average bargain price.
Put it there.
Average bargain price means we'll take the highest bargain price
It
plus
is nice.
lowest divided by 2. The lowest is 140 pence, highest is 155. So simply highest bargain price plus lowest divided by 2. So highest was how much? 155. It was 155 and the lowest is 140. 155 plus 140 divided by 2. So students, what are we getting? 155 plus 140 divided by 2. Please, can you be quick to answer this? 147.5 pence. So can I say we will value these shares at 147? Because the rule says value them lower off. Quarter up method and average bargain price. How many shares John has given as gift to the trust? Can I say 2,50,000?
Huh?
So the transfer value 2,50,000. 147
Okay,
pence.
can you now eat this bread?
Multiply this. If 147 pence, if you divide this
Eat
with
it then
100,
now. Buy. You can eat it then
you will
now.
get
Buy juice. You must not
1.47
disturb me now, right?
pounds. Are you getting this point? 2,50,000 multiplied by 1.47. I'm getting 3,67,500 pounds. Okay. Can I say you will not, even though annual exemption is available, but we cannot get the annual exemption? Please, student, reply why. Why I cannot get annual exemption? Even I'm saying it is available. I'm saying it is available, but still I'm not getting it. Why? Why I'm saying annual exempt amount 0? Student, please reply. The question says so. The question says so, that is why. Entire, can I say 3,67,000? 500 becomes your chargeable amount. Nil rate band 3,25,000. less last 7 years gross CLT prior to gift. We do not have. So entire 3,25,000 is available. Please, can you use a calculator? 3,67,500 minus 3,25,000. 3,67,500 minus 3,25,000. What are we getting? Be quick, student, please. Let's have a sip of black coffee. Yes. 42,500. Taxable amount is 42,500. Can I say if nothing is mentioned, then IST is paid by the donor, and which is 25%. And that 25% will be added to the chargeable amount to calculate gross chargeable amount. And that will be carried forward. Because if the donor dies within 7 years of CLT, then CLT becomes again taxable on death of the donor. IST payable. Please, I want you to use calculator. Take 25% of this. 25% of 42,500. 10,625. Thank you. If, can I say, donor was paying the tax, then tax rate would have been 20%. Nothing is mentioned. Donor pays 25%. And then this 25% will be added into gross chargeable amount that will be carried forward. Gross.
Are you eating? Yeah, it's sick.
Chargeable amount.
Sorry, can you
Carry forward. The chargeable amount is 3,67,500. IST will be added.
Okay, maybe Isaac make.
Can you be quick, please? Answering.
That's
What are we getting? Gross chargeable amount.
Juice for him, isn't it? You want juice? Okay, can you make juice?
No, please. It's a request. Oh. Please make sure your mic should be muted, please. Otherwise, it will create disturbance for obviously everyone, and plus it will create the disturbance for the recording as well. So it's my humble request. Make sure. Okay, the student is saying 3,78,125. 3,78,125. So the gross chargeable amount carried forward is 3,78,125. Let me repeat, if donor was required to pay the tax rate would have been 20%, and plus we are not supposed to add tax paid by the donor while calculating gross chargeable amount carried forward. This carried forward amount means if the donor dies, means the John dies within 7 years of the gift, then further IST will arise. Am I right? If John dies within 7 years of gift, then further IST will arise. Okay, now let's go for CGT implications. Let's go for CGT implications. Now let me tell you one thing. If you just recall what qualifies for the gift relief, if an asset which is immediately chargeable under IST, that asset also qualifies for gift relief. No matter the shares are not in a personal trading company, still that will qualify for gift relief. Let me repeat, the asset which is under IST immediately chargeable, like it is happening here in case of obviously gift to the trust, it is CLT. So in CGT, you will get the gift relief. But let's see CGT implications. Okay, students, when an individual, of course, when an individual gives gift of shares or sells the shares, we say it's the same thing. My question is, in case of individual, can anyone quickly tell us what is the identification rule? When an individual sells the shares in the same company. So what is the identification rule? Can I say number one is the same day purchases? Number two is the next 30-day purchases. And after that, all the shares which are in the pool. So all those shares which individual has bought in the same company before the date of disposal, can I say they actually fall in the pool? One more thing. When it comes to the quoted shares in case of capital gain, in case of capital gain, how do we value them? We value them according to the mid quoted price. We just value them according to the mid quoted price. So now let's come here. Very easily, I can calculate the mid quoted price 146 plus 150 divided by 2. Okay, now one more thing, 200,000 shares they were bought in 2008 at a cost of 1,49,000. After that, 75,000 shares were bought for 69,375. Subsequently, 10,000 shares for 14,800. Can I say there are no purchases on the day of gift? There are no purchases in the next 30 days. So simply, all the shares they are given as gift, they are coming from the pool. Am I right? So students, I want everyone try to calculate chargeable gain, please. And I'm giving you the hint, there are no shares on the same day, no shares in the next 30 days, everything is coming from the pool. I'm giving you just 3 to 4 minutes, and after that obviously we will attempt, don't worry at all, but I want you to try, please. You can take even 4 minutes. First of all, you have to calculate the mid quoted price, 146 plus 150 divided by 2. 146, 150 divided by 2. Let me use my calculator. 146 plus 150 divided by 2 gives me 148 pence. So we do not have any shares. Identification rule. Identification rule. Number one, shares purchase on same day. Can I say we do not have? Shares purchase in next 30 days. That is also no. Obviously, we'll go for shares in pool. Am I right? This is yes in our question. Simply shares and cost. Two columns, shares and cost. Let's come here. 200,000 shares in Orlean PLC during 2008 at a cost of 1,49,000. So you will start making the pool from the most Simply the earliest purchases will come first. So the earliest is 2008. 200,000, 1,49,000. It was the first purchase. Let's see what is the second purchase of shares in the company. That is 75,000 for 69,375, and the date is 15 August 2021. So August 21. $75,000 purchases of shares for 69,375. After that, we have 10,000 shares for 14,800, and that is 21st July 2022. July 22. 10,000 for 14,800. 2 lakh plus 75 plus 10 gives us 285. 1,49,000 plus 69,375 plus 14,800 gives me 2,33,175. And when we have given shares as gift, July 23, how many shares? 2,50,000. Gift, how many shares? 2,50,000. Basically, 2,85,000 shares. They are having total cost of 2,33,175. How will we calculate the cost of 2,50,000 shares? Simply cost of 2,50,000 shares. 2,33,175 divided by 285. That will give us the average cost per share into 250. 2,33,175 divided by 2,85,000 multiplied by 2,50,000. Students, I'm getting this 2,04,539.47. So leave that 47. 2,04,539. So the remaining shares are 35. And cost of these remaining shares 35 is 2,33,175 minus 2,04,539 gives us 28,636. Now very easily we can calculate the capital gain, chargeable gain. Of course, annual exemption we have to ignore. It is mentioned in the question. And we will take the market value as sale proceed. You can say deem sale proceeds, which is equal to the market value. Quoted shares, the market value for CGT purposes is the mid quoted price. When shares are quoted given as gift, then for CGT purposes they will be valued at average, or you average instead of mid quoted price, which we have calculated 148 pence, which means that 1.48 pounds. So 2,50,000 into 1.48 pounds gives us 3,70,000 pounds. Cost 2,04,539. Question. No, 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 no. It means you have not revised this. I think you have not revised the identification rule. Please revise the identification rule. Whenever we are selling the shares from the pool, it is always by using average cost. Got it? So you need to revise this identification. 3 lakh 70 minus 2 lakh 4,539 gives us the chargeable gain 1 lakh 65,461. I'm not deducting annual exempt amount because it is mentioned in the question. Ignore it. Chargeable gain. Now, student, please listen carefully. The asset which is immediately chargeable under IST that qualifies for the gift relief, even though that donor, that is John, does not have 5% holding in this company, it's not a personal trading company, but still gift relief is available. Why gift relief is available? Because this gift is immediately chargeable under IST. So simply gift holdover relief is available because this disposal is immediately chargeable under IST. Immediately chargeable to IHT. So can I say due to gift holdover relief, John can defer the IST on this gain. So simply, John can elect gift relief to defer all the gain. Therefore, no CGT payable. And that's logical. He should be doing this because there's no benefit of paying CGT right now. Okay, now let's come here. That was all about part A. Now B. On 15 July 2023, John gave 20,000 of her 40,000 ordinary shares in Ruin Limited, an unquoted trading company, to her son Michael. So in case of unquoted company, the share price will be given to you. Okay. Royal Limited has an issued share capital 1 lakh ordinary shares. John husband also owns 40% ordinary shares. So can I say if company is having 1 lakh share, John is having 40, husband is having 40. So 80% holding is between husband and wife. Under IST, we always work on the combined holding of husband and wife. Okay. On 15 July 2023, the relevant value of the Rowan Limited shares were as follows. In case of 100% holding, that is right now not relevant for us. Can I say 80% holding is relevant? So before the gift, can I say the total holding is 80%? That is husband plus the wife. After the gift, can I say the holding reduces from 80 to 60? Because they will be having 60,000 shares out of 1 lakh after the gift. So holding reduces from 80 to 60. Before the gift, the holding is 80%. After the gift, the holding is 60%. Okay. I have a question, students. The question is, can you tell me the name of the topic which we are dealing right now under IST? It is, the first word is related. The first word of the topic is related. After that, there's one more word. I'm not using it. Otherwise, you will get to know. So which topic of IST? Okay, let's see who has given the answer. Excellent. Related property. We're dealing with related property. Great. And can I say, when one individual gives gift to another individual, gift from one individual to another individual is PAT. Let's deal with ordinary shares and ruin limited IST implications. That's a related property scenario. Great. Part B. Ordinary shares in ruin limited. IST implications. Gift to son, that is PAT. Under related property, the holding is 80% before the gift. So value of shares before transfer, value of shares. Shares are 40,000 with the John, but the holding is 80. Combined holding, husband and wife. At 80% holding, the relevant share price is 17.10. After that, it becomes 14.50. 17.10, which actually represents the holding 80%. And value of shares after transfer? Value of shares. 20,000. What was the share price? At 60%, it is 14.5. And the holding becomes 60. 40,000 multiplied by 17.10 gives us 6,84,000. 20,000 multiplied by 14.5, which gives us 2,90,000. So diminish value, the reduced value, which is given as a gift, the value transfer is the difference of 684,290. That is, so the value which is transferred, that is 3,94,000. Value transferred. Okay. Now, very important point. Of course, we know that gift from one individual to another individual, that is PAT. Okay. On PAT, there is no lifetime IST. Am I right? On PAT, there is no lifetime IST. But there is one more thing. What is that? Can I say due to combined holding of husband and wife? Due to combined holding of husband and wife, they have the control. Due to combined holding, they have a control. Can I say if you have a control, then 100% BPR is available. Then 100% BPR is available. Are you getting this point? But there is one condition that BPR will not be withdrawn. Can anyone tell us what is that condition? BPR will not be withdrawn. Can anyone tell us? BPR is 100% because of control. My question is, tell me when BPR will not be withdrawn. There's no chargeable amount. Can I say son needs to hold the shares at the date of death of John? Yes or no? Son needs to hold the shares. So let's see the name of the son. Son is Michael. Michael. Can I say if Michael still owns the shares at the death of John, then 100% BPR will be available, of course, and even at the time of death, there will be no taxable amount. Is this clear to everyone? So note number one is no IST on PAT during lifetime if Michael still owns the shares at the date of John's death, then still 100% BPR will be available. But can I say if John dies, number one, before the 7 years, and Michael has sold the shares, can I say then IST will arise? Yes or no? If John dies within 7 years of this gift, and Michael has sold the shares before the death of John, then IST will arise. I hope it is clear to everyone. Yes or no? Please quickly reply, student. It is clear to everyone. Now let's quickly see the CGT implications. In CGT, there is no such rule of related property. It is only in IST. CGT. So simply what is happening in CGT will be straightforward. How many shares John is giving as gift? 20,000. 20,000 means the holding. 20,000, only 20,000 represents 20% holding. At 20% holding, the market price is 7.9. And John bought these 40,000 shares for 96,400, which means that 50% of the shares are given as gift. Am I right? 50%. And shares are in an unquoted trading company. Can I say when gift of unquoted trading companies they are given, they are treated as a business asset. And gift relief is available on business assets. Due to gift relief, no CGT will arise. You can see that no related property rule when it comes to CGT. Very simple. We'll take the market value of 20%. Market value of 20% holding. 20,000 into 7.9 gives me 1,58,000 and half of the cost. 96,400. We are giving, John is giving gift 20 out of 40. 48,200. Again, no annual exempt amount because we have to ignore it. I'm getting 1,09,800. Chargeable gain. So can I say they can jointly elect the gift relief? Why? Because of business asset. Why we are saying business asset? Because Ruin Limited is an unquoted trading company. Both father and son jointly can elect gift relief due to business asset. Shares in an unquoted trading company or business assets. Can I say therefore no CGT payable? There's no CGT payable. Let's go. Okay, students, just read part C. Try to make your mind, and just give me 12 minutes break, prayer break. Inshallah, within 12 minutes, I'll be back. But I want everyone to attempt this part C. Just 12 minutes. Okay, students, let's quickly deal with part C. I think for the I just saw the question. For the calculation of 2,50,000 shares cost, we just went for pool. In the pool, we calculate cost on average method. Just we have taken the sum of all the shares, sum of all the cost, and it's here, I think. If you can see that. Straightforward calculation. This is how we calculated the cost of 2,50,000 shares. No, come here. CCC, part C. On 4 November 2023, John gave her grandson an antique vase. Again, gift from one individual to another individual, that is Pat. During lifetime, no tax on Pat. But can I say, if donor dies within 7 years, then Pat becomes chargeable. 18,500 as a wedding present, wedding present. Can I say in case of wedding present from the grandson, the exemption limit is 2,500. From parent, it is 5,000 pound, grandparent 2,500, and any other relative, it is 1,000 pound. So logically, 18,500 minus the wedding exemption, you have to take that. Only annual exemption examiner has told us to ignore it. So the PAT amount will be 16,000 and no tax on PAT unless John dies within 7 years of making the gift. So let's see, that is C antique vase. C. Okay, student, I'm just explaining the C here. Please listen to me carefully how to answer. I just want to save the time because one more reason. I have a class also after your class. You have to just put the heading of part C, IHT implication. And the first sentence will be gift from one individual to another individual is PAT. The second, you have to say due to wedding gift, there's an exemption of 2,500. So the PAT amount is 16,000. After that, you have to write no tax on PAT during lifetime. But if donor John dies within 7 years of PAT, then PAT becomes chargeable. This is what you have to deal with. Part C, IHT implications. Now, if I just quickly deal with the CGT implications. In case of CGT, the value of the VAS is treated as sale proceed, 18,500. The cost is 14,150. Simply, there is a chargeable gain of 4,340. On this 4,340, John will have to pay 20%, which is 870. And we know that on CGT, we pay tax on 31st January after the end of the tax year. The question is why we are not taking any gift relief. Can I say antique vase is not a business asset? Antique vase is not a business asset. That is why gift relief is not available. Second, why I'm using 20%? Student, can you reply this? Why I'm using 20%? Something was written in the requirement. Why I'm not going for 10%? Why 20? This is my question. On CGT, why I went directly for 20%? Why not? Why I did not check 10? Something was mentioned in the requirement. That is why I directly went for 20%. Can anyone tell us what was that? Which led us to go directly to 20%. Students, okay, let's see the answer. Ignore the annual exempt amount, it's okay. There's one more thing. Why I went for 20? Why not 10? This is my question. Students, please answer. I told you, be attentive. And it is written in the requirement. Can I say it is written in the requirement? John is a higher rate taxpayer. Yes. John is a higher rate taxpayer. So of course, John is a higher rate taxpayer. So we have to directly use how much? 20%, which I did it. Thank you. So student, now you have to properly draft part C, okay? I've explained all the IHT implications and CGT implications. We are doing this just to save the time. Otherwise, the video is going to be really long. Plus, after just few minutes, I have one more class. But don't worry. From next week onwards, inshallah, the grand live revision class is going to be long because my other subject will be completed. So I'll be giving you more time. Don't worry at all. Part D. On 15 January 2024, John gave agricultural land with an agriculture value 1,75,000 to her son Charles. Okay. Again, Pat. John had purchased the land for 92,000. It has always been let to a tenant farmers. Okay. It was bought on 2012. Given as gift 15 January 2024. Can I say number one, it is a PAT, and on PAT during the lifetime there is no tax. If the John dies within 7 years, then can I say PAT becomes chargeable? Am I right? PAT becomes chargeable. One more thing. Can I say 100% APR will be available? 100% agriculture property relief will be available on agriculture value of the land, which is 1,75,000. Why 100% APR will be available even though John is not doing himself any farming activity? Can I say the land was given to the tenant and the time period is more than 7 years? If the land is given to the tenant and 7 years or more have passed, 100% APR is available. But there's one condition as well. The condition is if the John dies, of course, within 7 years of the gift, then Dhoni should be holding this land at the time of death of John. Is this clear? Only then APR is available. Otherwise, it will be withdrawn. No APR then. Repeat. The discussion of IHT implication part D, I'm explaining in my wordings to save the time. I want you to see, you have to draft. I have explained D, IHT implications. Please, number one, the first sentence which you need to write is gift from one individual to another individual is PAT. Number one, no tax during lifetime. If donor dies within 7 years of PAT, then PAT becomes chargeable. Okay. Another thing is, even the PAT becomes chargeable as a result of death of, let's say, John. Okay. Can I say still 100% APR will be available on the agriculture value of the land, which is 1,75,000? Why it will be available? Because the land was given on a rent and tenant for at least more than 7 years here. Because if the time period is 7 or more, then APR is available, but there's a condition. The condition is Dhoni should be holding that land at the time of death of John. This is what you need to simply discuss. What else? Come here. Okay. The most recent tenancy agreement, which is started in June 2014, will soon end. And John has obtained the planning permission to build residential accommodation on the land. The value of the land planning permission is 3 lakh. Charles on adjoining agricultural land, and the value of the land will increases from 210 to 250. Can I say the increase in the value? Increase in the value is irrelevant. Yes or no? Increase in the value is irrelevant. So we'll be just working on the value of a land. So simply what value we have to take? The most recent tenancy agreement, which is started in June 14, will soon end, and John has obtained the planning permission and build residential accommodation on this land. The value of the land with the planning permission is 3 lakh. So we are going to work on this 300,000. We are going to work on this 300,000. Okay, now let's talk about CGT implications. Very simple. Can I say when it comes to CGT implication, at the time of gift, 3 lakh will be taken as a sale proceed. It was purchased for 92. There's a chargeable gain of 2 lakh, 8,000. There's a chargeable gain of 2 lakh, 8,000. Okay. Now there's a question that basically due to availability of APR, this asset also qualifies for gift relief. Did you get this point? Due to availability of AP, it is mentioned in your, I would say, focus notes. The asset on which APR is available, you can get gift relief. So simply John and Charles, they can make the joint election to get the gift relief. Why gift relief is available? Because this on this asset under IHT, APR is available. Is this clear? Therefore, no CGT implications. I'm repeating it. Student, that's a very important point. Asset on which APR is available under CGT, you get gift relief. So you have to mention this. Due to the availability of APR, this qualifies for gift holdover relief. So John and Charles, they will make joint election for the gift relief, so no CGT implications. That is the all discussion about part D. Now let's go for E, the last part quickly. On 31st March 2024, John made a gift of her main residence in Wales valued 2,65,000 to her daughter. Stop. Can I say again? Gift from one individual to another individual, that is PAT. No tax on PAT, am I right? During the lifetime. However, as a condition of gift, John has continued to live in the house rent free. Students, give me the name of a topic under IST. John has given the gift but is still using that asset. Rent free, not paying any rent. What is this? Excellent. It is gift with reservation. It is gift with reservation. It is gift with reservation. And if this reservation is not uplifted before the death of the John, then normally that will be added to the death estate of the John. Because in that way, HMRC will get a higher IST. So it is gift with a reservation. You need to discuss the rule of gift with a reservation. The house was purchased on 1st July 2002 for 67,000 and John occupied it as her main residence until December 2006. The house was unoccupied between 1st January to 2007, December 10. It was rented out as a furnished accommodation. Since July 2003, John has again occupied the house as her main residence. John has not previously made any lifetime transfer of asset. She is to pay. It is also saying John will be paying the IST. Otherwise, we know that nothing is mentioned. Donor pays IST. Now, let me tell you. Main residence, what are the IST implications? Student, you have to just mention number one. Gift from one individual to another individual is PAT. PAT becomes chargeable if donor dies within 7 years of the gift. But here, it is a gift with a reservation. It is a gift with reservation. And if the reservation is not uplifted before the death of the John, then obviously HMRC will simply add that value of main residence to the death estate of John. Okay, now let's go for CGT implication. Under CGT implication, students, the market value is treated as sale proceed. We will take sale proceed 2,65,000. We'll deduct the cost 67. We'll get chargeable gain, but from that chargeable gain, we will deduct principal. Simply we'll deduct private residence relief. And after that, whatever the gain comes, IST rate will be 28%. Why IST rate will be 28%? One, John is a higher taxpayer. Second, actually you are selling a residential property in the UK. In case of availability of a basic rate band, applicable CGT rate is 18%, otherwise 28. John is a higher rate taxpayer, so applicable CGT rate is 28%. So let me quickly explain CGT part of part E. IST I have explained, okay? Please, you have to deal with IST part, CGT, and no gift relief will be available. Student, can I say why gift relief will not be available? Because main residence is not a business asset. Deemed disposal proceeds will be the market value. 2,65,000. Cost is 67. That gives us the gain 1,98,000. Less private residence relief. If letting relief is available, which I can't see that happening, because now the letting relief is only available when one portion of the property is given on gift or given on rent, another portion is retained by the landlord. Only then letting relief is available, otherwise it is not available. After deducting both this, you will get a chargeable gain. Whatever the chargeable gain comes, applicable rate will be 28%. Why 28%? Because John is a higher taxpayer. And another important point is, whatever CGT payable comes, students, that CGT payable will be paid within 60 days. This CGT will be paid within 60 days. It will not be paid with the normal other capital gain, because normal CGT payable date is 31st January after the end of the tax year. But that does not apply when it comes to the disposal of residential properties. In case of residential properties, you have to pay within 60 days. Okay, student, I'm just giving you a little idea. I want everyone to complete this. If you have any issues, you can always ask in your relevant WhatsApp group. Let me tell you what you have to do. You have to calculate occupation periods. Actual occupation months are exempt. Can I say absent for 3 years due to any reason is also exempt, but provided that that is preceded and followed by actual occupation. One more thing. Can I say last 9 months of the ownership, they are always exempt. Exempt months, I'm repeating. Number one, actual occupation. Second, absent for 3 years due to any reason. And the last one is last 9 months of the ownership, irrespective of any condition. They are always treated as exempt months. In this question, we are not getting any letting relief. Why? Even though the property was given on rent, but owner was not living. Letting relief is only available when one portion of the property is given on rent, another portion is occupied by the owner. Only then you get the letting relief. So logically, there will be no letting relief, but you will get principal residence. You will be getting the relief on this. PRP will be available to you. But for getting this private residence relief, for getting this private residence relief, this is, make it one more R. To get this private residence relief, you have to calculate exempt months. In this question, exempt months are actual occupation, absent for 3 years due to any reason, and the last 9 months of the ownership. So you will get private residence relief. Take the amount of the gain, 198, multiply by exempt months, divided by, can I say, ownership period. And if you recall, how do we calculate ownership period? I have explained that through a mathematical equation that makes the life easier. So it's a very small homework, student. I want everyone to do this, complete this. If you have any question, you can always ask in your relevant WhatsApp groups. In the next live, grand live revision class, the time period will be very long. At least you should be mentally prepared. The next grand live revision class in a coming week is going to be at least 5 hours long. And in that class, we'll be discussing number of topics. We'll be revising number of topics. I hope that today's class you people have enjoyed, but I want everyone to complete this question nicely. Again, you have any question, you can always ask in your relevant WhatsApp groups. So thank you very much for attending today's class that you people have taken out time. See you all inshallah.